Hey everyone, welcome back to part 2 of defined contribution plans. In part 1, we reviewed the benefits of tax deferral and some of the common investment options, and in this video, I'm going to show you how to calculate the impact of management fees, discuss the differences between a Roth and a traditional retirement account, and how to quantify which one is optimal, and lastly, touch on how much of your pay you should contribute to an employer-sponsored plan. Hey everyone, this is Michael Tortorich and thanks for tuning in. Just a quick note in the video before I get started. These videos are designed to complement my book, Running the Numbers, a step-by-step guide to life's major financial decisions. Each video corresponds to a chapter or section in the book, and the idea is to review the chapters and use these videos as a platform to add some additional color around the examples where it just wasn't practical to do in the book. So, to check out the book or additional videos, please visit my website at michaeltortorichfinance.com, and there's also a link to the website and the book in the description below. So we left off in the previous video by reviewing some of the common investment choices, and one of the differences we saw between the active and the passively managed funds is that actively managed funds charge higher fees. Now, all funds are going to have some kind of fee, and typically fees range from about 0.2% on the low end, and this would be for a large index fund, all the way to around 2.5% on the high end for an actively managed fund. And management fees are calculated as a percentage of assets under management. In other words, the value of the investment the fund is managing on the investor's behalf. So let's continue this analysis and look at an example of how we can compare the impact that different management fees will have on an investment over time. So let's assume you're choosing between two funds that are offered via your employer's defined contribution plan. One is a passively managed S&P 500 index fund, and the other is an actively managed fund. Let's also assume that the management fees, and you may also see these referred to as the expense ratio, are 0.2% and 2.5% respectively. You're currently 25 years old, you'll invest $10,000, and you're going to make a 6% yearly return, and we'll take the money out at 60 years old. So first we'll look at what happens if you invest in the actively managed fund. So let's jump to Excel, and this spreadsheet can be found on my website, michaeltortorichfinance.com, and you can see there what the calculations look like. So here you can see we're on the Impact of Management Fees tab, and starting on the top left of the tab, you can see the previous assumptions we went through. And you'll notice that there are yellow highlighted cells, and these denote input cells. On every tab, there's an assumption section, and by changing any of the values in the yellow highlighted input cells, these calculations will update and flow through the rest of the formulas. So, if we take a look at the initial investment in year one, you can see the investment is $10,000. The return is $600, which is $10,000 multiplied by our yearly rate of return of 6%. Now, remember, the management fee is calculated on the entire assets under management. And assuming the fee is calculated at the end of the year, the assets under management will be $10,600. So the fee is calculated by multiplying 2.5% times the $10,600 to get a management fee for year one of $265. So the investment amount at the end of the first year is $10,335. Now in year two, you'll make again a 6% return on the $10,335, which is $620 for a balance at the end of the second year of $10,955. And again, the management fees are going to be calculated on this entire amount, which is 2.5% times $10,955 for management fee at the end of the second year of $274. And this brings the total amount of the investment after fees at the end of the second year of $10,681. Now, this is going to continue every year for 35 years. And you can see at the end of 35 years, the total before tax account balance will be $31,686. Now you can also do this calculation using a formula, which is how I show it in the book, and the formula is a slight derivation of the compound interest formula, and that's because we have to apply the management fee to the entire amount invested. So let's actually take a quick look and I'll show you how to calculate the future investment value via the formula as well. So again, this is really just the compound interest formula with an added term in the middle for management fees, which you can see here. And the 1 minus the management fee is multiplied by 1 plus the interest rate because the management fee is applied to the value of not only the investment returns but also the principal invested. Now, please make sure to mind the parentheses in this formula and use the correct order of operations. So let's go through it here. First, add 1 plus the interest rate, which is 1.06. Next, we subtract 1 minus the management fee, which is 0.975, and then you multiply the two, which gives us 1.0335. Next, we raise that to the power of the number of periods, which gives us 3.169, and multiply that by the principal investment of $10,000 to get $31,686. So now let's jump back to the Excel and take a look at the last step, which is to calculate the tax amount. The tax rate is 15%, so there will be taxes due of $4,753 when the amount is withdrawn for an after-tax amount after 35 years of $26,933. So next, let's look at the same investment of $10,000 in an index fund and see how much we end up with after 35 years. And the only difference here from the previous example we just did is going to be a lower management fee of 0.2%. So if we jump back to Excel and we take a look at the initial investment in year one, you can see, again, the investment is $10,000 and the return is $600. And the management fee, which is calculated on the total assets under management, is 0.2%. So we'll take 0.2% times the $10,600 to get a management fee at the end of year one of $21. And so the total investment amount at the end of the first year is $10,579. In year two, again, you make a 6% return on the $10,579, which is $635 for a balance at the end of the second year of $11,214. The management fee of 0.2% is applied on the entire amount for a fee in year two of $22. And this brings the total amount of investable assets after fees at the end of year two to $11,191. Again, this will continue every year for 35 years, and at the end of 35 years, the total before tax account balance will be $71,660. Now, lastly, we're going to calculate taxes, and the taxes will be $10,749 for an after-tax amount of $60,911. And so we can see with the higher management fees, you end up with $26,933 versus $60,911 with the lower fees. And even though the higher management fee only differs by 2.3%, the impact is huge, and you lose over half your future gains to additional fees. Now, this example assumes only a one-time contribution, and I did that on purpose to make the example a bit easier and help convey the concept. But typically, people are contributing money to their defined contribution accounts every year. So I have another example in the same Excel tab that shows the difference of ending account values assuming a $10,000 contribution is made not only at the beginning of the first year, but every year for the entire 35-year period. So if we take a look at the Excel, and I'm not going to go through the calculations again in detail because it's really the same methodology as before, but you can see in the assumptions, in addition to the beginning principal, I've added an input for a yearly investment amount. And if we take a look at the final after-tax values after 35 years, with the higher management fees from the actively managed fund, we end up with $568,600 $674, and with the lower management fees from the index fund, we end up with $957,916. And again, a huge amount of your investment is eaten up due to management fees. So just to summarize this section, fees should be kept at a minimum as they cause significant drain to your investment returns. So now let's talk about the different types of defined contribution plans. And I'll start with the 401k. And as I mentioned in part 1 of the video, the 401k, the 403b, and the thrift savings plans are all very similar. So I'm going to use the 401k as a proxy for all three in any examples I give going forward. So just to review, a 401k is an employer-offered tax-deferred retirement account, and you contribute directly from your paycheck on a pre-tax basis, in other words, before you pay taxes on your salary, and you invest in a fund of your choosing. Now, the limit as of 2020 is $19,500 per year if you're under 50 years old, and $26,000 per year if you're over 50 years old. And at 59.5, you can withdraw the money without penalty, and you pay your ordinary income taxes on any amount you withdraw. Next is an IRA, or an individual retirement account, and this is almost identical to the 401k, except it's for people that don't have an employer-sponsored plan, and it has slightly lower contribution limits. So as of 2020, the limit for an IRA was $6,000 per year if you're under 50, and $7,000 per year if you're over 50 years old. And you can set up this account by yourself, either through your local bank or with your investment broker, so for example, E-Trade or Vanguard or Fidelity. And contributions are made again on a pre-tax basis, and at 59.5, you can withdraw the money without penalty, and you pay ordinary income taxes on any amount you withdraw. Now, for both the 401k and the IRA, there are Roth versions. And a Roth 401k or IRA is the exact same as its non-Roth counterpart, except that you contribute to the accounts after tax. In other words, you pay taxes on the money now. And the funds then grow tax-free, and then when you withdraw the funds after age 59.5, any withdrawal is tax-free. And most employers will actually have both a Roth and a non-Roth option for their defined contribution plans. So how do you choose between investing in a Roth or a non-Roth account? Well, the major determining factor is your tax rate. Now, with a regular 401k or an IRA, you pay taxes when you withdraw the money. And as most people start withdrawing the money after they retire and are not working, their tax rate is usually lower. So if you think you'll have a lower tax rate in retirement, you should delay paying taxes and choose the traditional 401k or IRA. But if you think you'll have a higher tax rate in retirement, then you should pay taxes now and take your money tax-free later on. In other words, go with the Roth account. So let's take a look at an example and see how the different tax rate assumptions impact the non-Roth versus the Roth retirement account. So in this example, let's assume you have $10,000 to invest for 35 years. You'll earn a 6% return, and your retirement tax rate is 15%, and you're going to invest in a non-Roth 401k or IRA, in other words, a pre-tax account. And this is simply a future value calculation, and we can use the compound interest formula. So let's go ahead and plug in those assumptions into the compound interest formula, which is the principal times 1 plus the interest rate to the power of the number of periods. And this will be 10,000 times 1.06 to the 35th power, which is 10,000 times 7.686. And so we can see that the $10,000 grows to $76,861 after 35 years. Next, we apply taxes when the money is withdrawn, and as the tax rate is 15%, we multiply the $76,861 by 1 minus the tax rate, and that gives us an after-tax amount of $65,332. Now let's take a look at how your money will grow by investing in a Roth 401k or IRA, in other words, an after-tax account. And we'll use the same assumptions as the previous example in the non-Roth version, with one exception, the tax rate. And that's because you're currently working, so we're going to assume your current tax rate is 20% instead of 15% in the prior example. And again, we calculate the future value using the compound interest formula. And because you have to pay taxes now, we multiply the principal of 10,000 times 1 minus the tax rate of 20%, which gives us an after-tax investable amount of $8,000. Next, we multiply 1 plus the interest rate to the power of the number of periods, which is 1.06 to the 35th power, and that's going to give us 7.686. And then lastly, we'll multiply that times the principal of $8,000, which gives us $61,489 at the end of 35 years. And this is less than the non-Roth example, and that's because the current tax rate is higher at 20% versus the previous example when the tax rate was 15%. So by paying taxes now, you actually realize a higher tax rate than if you had waited. So in summary, you should go with whatever account will allow you to realize the lowest tax rate. If your current tax rate is expected to be lower than in retirement, you should pay taxes now. In other words, go with the Roth account. If you think your retirement tax rate will be lower, then you should go with the traditional, in other words, a non-Roth account. Now, the last thing you need to consider is any potential changes in the future political landscape. And this is entirely possible that the government will change the tax laws. And if you haven't paid taxes on your money and the tax laws are changed unfavorably, in other words, they increase, you might face a negative impact to your standard of living. So even if you think you will have a lower tax rate in retirement, it may be wise to put something in a Roth account just in case. Now, personally, I contribute funds to both a Roth and a non-Roth account just to hedge my bets. So the last thing I want to talk about is how to maximize the benefit from your defined contribution plan. So let's get into that. Now, as I mentioned before, employers will typically offer to match a portion of your contribution, and usually they'll offer some percentage of your salary up to a certain dollar amount. Now, while I can't tell you exactly how much to contribute because that's specific to each person, it depends also on your retirement needs, at a minimum, you should always contribute enough to maximize your employer match. So let's actually go through an example of that and see how that works. So let's say your employer offers to match your contribution to your 401k dollar for dollar up to 3% of your salary, and you make $100,000 per year. This means your employer will contribute up to an additional $3,000 to your 401k. So if you contribute 3% of your salary, in other words, $3,000, you're actually going to get $6,000 in your account. And the additional $3,000 contributed by your employer is free money, and it's 100% risk-free. So in this example, if you contribute anything less than the 3%, you're essentially leaving free money on the table. So therefore, you should always contribute enough to at least maximize your employer match no matter what. So that takes us to the end of this chapter, and if you liked the video, please don't forget to subscribe and hit the like button, and also stay tuned for my next video on Chapter 8, where I'll discuss purchasing a home, and for more information on the book or additional videos, you can also check out the links in the description below or my website at michaeltortorichfinance.com. Thanks for watching.